Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He believes it's too early to say if the markets are in a corrective mode. Gold has hit $3,000 for the first time, and silver still might have room to go higher. CEO of InsideTrackTrading.com, Eric Hadik, takes a look at the cycles that seem to affect the stock markets, crude, gold, the U.S. and Canadian dollars, and even wars. Publisher of the TrendLetter.com, Martin Straith, gives us some clues on how to deal with such a volatile market and an unpredictable White House. He looks at currencies, copper, gold, and decentralized finance, or DeFi. Martin also has a special offer for our listeners. Author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, chimes in on President Trump's tariff war against Canada and much of the world, and how foreign insiders might be using Canadian government help to take over Pricey real estate. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Good to be with you, Jim, and another one of those weeks with a lot of price activity and volatility and anxiety for any of the investors.
Are we tipping into a major market correction, or is it too soon to tell?
No. This is so. We finished the bull market from 2009 or from 2020 to. It's a straight line up for so many years, and we're into the consolidation phase. Does it become a bear market? Who knows? The fact is that the rolling top that started back here in the middle of November had some really good downside targets. We had some Bollinger Bands and moving averages on the weekly charts. All pointed down for S&P targets, down roughly 8 to 10%. 5,500 round numbers for the S&P was a significant target. We got there just over a week ago, and now the VIX, the volatility index, just shot up to highest levels in months. Anxiety level then showing up there. The options volume, both puts and calls, has just gone through the roof. People are both buying protection and also, selling some options to take advantage of the high premiums by selling some puts. So the indices are bouncing as of Friday off just some really good support areas. As of this week, the four major indices, the S&P, the NASDAQ, the Dow, and the Russell, all had downside capitulations on our models. So this is 11 times since 1999. Doesn't happen that often. And every single one, without exception, when it had its upside reversal day like we've had on Friday, you get a pretty good bounce out of that. We've got good targets on the upside that were sent off to subscribers. So it's looking like there's good trading opportunities. Forget about the buy and holds. We're into a trading style of market. This turn this week is one you want to take advantage of. You're probably going to be flattening out that position before the end of the month. Here we are coming up on the end of the calendar quarter, so there's going to be some book squaring happening by all the big funds, etc. So, it's great for the short-term traders, and if you're a long-term investor, you look for some of the really oversold items. We have a model that looks at the individual stocks and ETFs for times when you get both oversold weekly and oversold daily signals on the modeling that we've got. And when they kick in together, you get some very, very nice turns. So, since the middle of December, on the NASDAQ and S&P stocks, where you've got 10 billion more or more in market cap, we've had 32 signals there, and all but 4 of them have had really nice trading reversals. And as of the end of this week, actually as of Thursday, we got brand new signals and good reversals on Friday. So individual stocks and ETFs really showing some good opportunities in here.
What's going on with gold?
Gold, it's just stair-stepping its way up so nicely. Here we are, spot price over $3,000. Gosh, I remember when we first went through $200. I'm dating myself here. But good methodical uptrend. And, we've got the gold market, once it does start trending, it tends to then just step up. You make new highs, you pull back, test the breakouts, and then you go again. At this point, we're getting maybe a little bit excessive at the top end of the week. Silver's come to life. It's another one of those that finally joined the parade, and there's lots and lots of talk about potential short squeeze over in the silver market. I think I hear that every 5 or 10 years when the silver market comes to life, everybody comes out of the woodwork. But that one is definitely making headlines right now. The patterns, if we take a look at the size of the consolidation in these precious metals, the gold consolidation of the last 2 years provides good targets up around 3280 when you measure the depth of the base that we've come out of. And then if you look at the longer-term consolidation of the last 5 or 10 years, the Fibonacci target is up just over 3,300. So I would suspect that, somewhere before we get through to this summer, we will have seen those higher numbers and then be ready for, a pretty decent correction. But right now, the U.S. dollar has been weak, and the precious metals have really enjoyed that. The safe haven aspect of it has been kicking in. I mean, it definitely makes the headlines. Everybody loves to talk about it, and it's doing what it should be doing. Big inflow of funds into things like the GLD ETF, and I'm sure that we'll see a real squeeze on the silver market. I was looking at the COT numbers, commitment of traders numbers at the end of the week here. The gold numbers actually show that the speculators have backed off on their positions, whereas in silver, they're adding to it. We're not at extremes as of yet, so we'll be watching for that in the coming weeks. I think my intermediate target for silver has been up around 38. I mean, that was established over a year ago. It's been slow in coming to life, but here we are through 34, and we're on our way to maybe some excesses as we move along. Typically, both gold and silver will generate sequential 9 setups at the top or bottom of these short-term swings, and we haven't had one of those in months now. The silver market does have a sequential 9. The gold market is going to take at least another 3 or 4 days before it puts one into place, so we'll just be watching for that, maybe as possibly an interim high for the metals, but all within the context of a rising trend.
What's going on with crude oil?
Crude oil just biding its time down here, flatlining, and we took a look at the USO and the crude oil itself. Got a potential for a pretty decent move off the bottom, and seasonally, we're at the point where we should be ready for the next move. I don't have anything that's kicking in as of yet, but I would suggest that if there's some upside reversals here in the near term, you want to go with it and enjoy the play. The other big market has been over in the treasuries. The bond market had a really good low back in January, and we rallied up into the first part of March. Sell signal on the bond market looked as though we were going to correct for maybe 5 to 10 days. We've done that. We're back into a good support area. The bonds have given back about 38% of Fibonacci number of the move off the bottom. They're at the 50-day moving average. It's a great place to find support in here. So I would think if we hold around this level, the bond market could have a pretty good move into the spring, and I would suggest that we're going back through the highs that we saw in December.
What's happening with the U.S. and Canadian dollars?
U.S. dollar, we peaked up at 110, took the hard break down to just under 104. Been down here for just over a week now. Lots of good oversold readings in here, and there's stability starting to show. Looks as though it's ready for a bounce. If we take a look at things like the British pound, it's had a big move on the upside, and now it looks excessive up there and probably ready to pull back. The same thing in the euro. So currency-wise, I think it's time for a little backing and filling to happen in there. Good for short-term traders, but I don't think it's anything for a long-term buy and hold.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark from ChartsandMarkets.com. You can find him on X at Charts by Ross. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, thanks for having me back, Jim. Always a pleasure.
Can you tell us a bit about Inside Track, spelled with 2 I's, and how our listeners can subscribe?
Yes, Inside Track is a financial analysis publication focusing on technical and cyclical research and analysis in the financial futures markets, although it also, that's kind of its core, but we've expanded quite significantly into most of the heavily traded markets of the day. And the best place to get information, samples, a lot of archived reports is at our main website at Inside Track Trading, and that is inside spelled with 2 I's in the middle. So it's INSIIDE, tracktrading.com.
Do trade wars and tariffs have cycles?
I think on a longer-term basis, they certainly do. And in some respects, it moves a little bit like the 80-year cycle of war that I've talked about so many times. Really, the whole free trade experiment that we've seen over the last couple generations started at the end of World War II. And before that, it was a lot more protectionism and tariffs throughout the history of America and some of Europe going back before that. So there is certainly a little bit of a cyclic nature to it. I also think that there are a lot of intended and unintended consequences of things like that, both positive and negative. And it's, there's a lot of strong argument for some tariffs and from America's perspective, leveling out the playing field and bringing some manufacturing back home. But I also think that a lot of times individuals are very naive or ignorant to the cost ramifications of that. And, if you get that play out the way they want to, then you don't get to go down to the big box store and get everything for cheap, 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 because you're wanting to pay every laborer involved in the creation of your products a living wage. And so you get one or the other. Either you get the cheap, cheap, cheap prices without the tariffs and protectionism, or you get significantly higher prices with it. And so it's just a thing of going into it eyes wide open. If that's what you're in favor of, then fine, but don't then later complain that, oh, these things are so expensive, I didn't buy into that. So, and that's probably why you have some of these cycles that oscillate up and down through related events like that. And when I say related, you can even see something like another unintended consequence is the potential loss of key customers. And you look back to something like the grain embargo of 1980, and there were a lot of reasons for that, and it was to penalize the Soviets. But what quickly happened is the Soviets discovered a whole new supply chain in South America and a lot of other places. And so for decades to follow, the American farmer was kind of paying the consequences of that embargo, which, is not exactly the same as tariff, but a lot of the end results are similar. And even now, as a lot of these tariffs are being imposed by the U.S. and then retaliatory back on the U.S., you're already reading and hearing of major trading partners realizing that they need to expand their horizons and see who else they can trade with so that they don't get this kind of whiplash back and forth in the future. And you may look back in 5 or 10 years and say, okay, there was a seismic shift in specific trading partners and a lot of unintended consequences that came as a result of that.
What's the latest on the cycles involving war?
Well, I've talked about that many times before, and there's the 80-year cycle, which is why throughout the 2010s, 20-teens, I kept saying that we wouldn't really see war kick in until late 2021 through late 2025, which was 80 years from 1941 to 45, which was 80 years from 1861 to 1865, and going back to the culmination of the Revolutionary War, 1781 to 83. And so you've had this very consistent from America's perspective, but you can also trace it back, and I have traced it back all the way into the 1200s from Europe's perspective, of a very consistent 80-year cycle of war. So we are in the kind of culminating phases of that in 2025. And so, during those culminating phases, you often get some of the worst of times and best of times as a war cycle like that hits its crescendo and then dramatically shifts.
Is gold following seasonality cycles?
Well, it is certainly following the multi-month and multi-year cycles that I've discussed and documented for the last 8-10 years. And one of the most consistent is an approximate 12.5 to 13.5 month cycle in gold. It often comes down to around 54, 55 weeks. And most recently, that was the cycle why I thought we would see a multi-month top in late October, but that would be a precursor to a future higher peak in early November to mid-November of 2025. So we're in between those two 54-week cycles. And along with that, you often see the midpoints of those cycles time some reinforcing or corroborating peaks. So I have been looking for an intervening peak in gold in early to mid-May at that 27-month or so, 27-week cycle midpoint between late October of 2024 and early November of 2025. And so that's kind of where it's at now. You saw gold see its kind of quick correction back in the fourth quarter of last year. Then it stayed in consolidation for about 3 months and then started to break out as those bullish cycles began to impose more of their influence. And it could stretch into early May with certainly some volatility in the midst of there. Not that I think it's going straight up from here until there. But then you've got silver kind of playing on a little bit different cyclic interval and periodicity. And so silver is kind of at a critical point right now where it has just started to break out to the upside this week, but the weekly close, the Friday close, is going to be the real key of whether silver shows something more sustained or this is still in the midst of a very broad trading range that it has been in since those late October highs.
The U.S. dollar has been pulling back at the same time as the stock markets. Do the U.S. dollar and stock market cycles tend to move together?
For the most part, I would say no, but as I express in one of my trading axioms, I call it the axiom of market correlation, it all depends on what traders are most acutely focused on at whatever given point in time. And so if you had a bearish stock market starting to make it look like, okay, interest rates might start coming down, so then the dollar comes down with that, then you had stock markets kind of leading that. But the inverse of that is if you had stock market heading up, but it was kind of on the backs of interest rate cuts, you might get the dollar going down while the stock market's going up because of different leading indicators and leading markets. So I wouldn't say that they move hand in hand, but when you get some of your more extreme moves or moves that veer out of a recent realm of normalcy, so when you have the stock market starting to drop sharper and in a more sustained fashion than what has been seen for quite some time, then it does start to inflict some of its influence over the dollar and over other related vehicles.
Where is the Canadian dollar in its cycle?
Canadian dollar remains in a very bearish cycle. I could see it really wait until the middle of this year before hitting a final bottom. June, July is kind of the time that I'm looking at from a multi-month and multi-year cycle. But that's very broad, so I would be focused on price action between now and then to see if there's any indications that a low is taking hold before then. But if that cycle holds true, you might get a low in here in the near future and see a bounce and then maybe one more test of the lows coming into that mid-year period.
Stock markets have been dropping since we last talked. Does it look like the stock markets could have bottomed this week?
Well, the stock markets still seem to be pretty weak and heading down. So, as far as trying to catch a falling knife, it's kind of in that realm. The one thing that is mildly positive, I guess I would say, for lack of a better term, is that ever since late November, when I explained why the S&P Mid-Cap 400, the Russell 2000, the Dow Transports were all showing me we should see a multi-month, multi-quarter top. And my downside target for the Mid-Cap was for it to first see a quick, sharp drop down to about 3,100, but then make its way down to 2,850, and looking at the March-April time frame for an initial low in that overall sell-off. Well, just today we hit 2,845 on the mid-cap, so we have fulfilled that downside, and at the same time the Russell 2000 has just spiked below 2,000, which was the downside target for that. The NASDAQ 100 and S&P 500 are hitting some downside targets, a little bit above 19,000 in the NASDAQ 100 and around 5,500 in the S&P 500, and I'm looking at futures here. So most of these indexes are hitting those lows, or those targets, I should say, and they're doing it right in the time frame that I described, that we should see at least a 1 to 2 week bottom, especially coming in relationship to some previous lows. You had the Dow and a lot of the indexes initially bottom on January 13th, and you often see this kind of geometric 30 and 60 day, 1 and 2 month cycles between some of these intermediate turning points. And so that's why I thought we would see stocks sell off into the current time frame right around March 12th, 13th, right where we are now. And so you have at least some intermediate time frames and cycles coinciding with the attainment of these downside price targets. So if we could see a little bounce into the March 14th weekly close, you could see a bit of a rally take hold from here, but I don't think that will be a final low in this overall decline in stock indexes.
The price of crude oil has been dropping along with the stock markets and the U.S. dollar. Is the crude oil cycle in sync with the stock markets and the U.S. dollar?
I don't know that I see that as a regular correlation. Once again, with the stock market selling off a little bit more extreme than normal, it certainly is having its bearish effect on a lot of other markets in fears of recession or, pullback in spending and consumption. So you certainly have that going, and crude there are times where it moves in closer lockstep with equities, but not as much the dollar. In fact, often they're a little bit more of an inverse correlation, since as the value of the dollar strengthens, then that often suppresses demand for certain commodities, and as the dollar drops, you sometimes get a lot of commodities and imports and whatnot moving higher. So it's more a correlation between crude and stock market. I've sometimes referred to the energy equity connection, but I have been looking for, since December, for the next important low in the related XLE, which is oil and gas ETF, and XOI, the oil and gas index. Both of them, I have been saying I thought we would see their next significant bottoms in the first half of March, which we are seeing right here. And if those markets and crude oil are able to bottom right in here before mid-month and start to show signs of reversing higher, we could have a 1 to 2 month low set in the overall energy sector.
Bitcoin's been pulling back along with the stock markets, the U.S. dollar, and crude. Where is Bitcoin in its cycle?
Bitcoin remains in a bearish part of its cycle on an intermediate basis. I explained before how late 2024 and early 2025, very specifically December and January, had a lot of monthly cycles converging in various cryptocurrency, and why I thought we would see a multi-month top there. Ever since Bitcoin hit 108,000, which was some important upside range target, I've explained why I thought Bitcoin needed to drop back to 72 to 74,000 before we would have a chance of entering a new wave higher. And so we've continued to move towards that downside target. We just hit some initial support around 77,000, and we could get a bounce from there. But I think that ultimately it needs to make it down probably even closer to 70,000 before you're going to find some significant support.
The Bank of Canada this week dropped the bank rate by a quarter point to 2.75%. What do you expect the Fed to do this coming week?
Well, I'm not a real aggressive or intense Fed watcher as far as each meeting and each interest rate move or communique. But I do think that as you see the stock market continuing to sell off and now starting to impact things like consumer confidence and spending, that it has certainly given the Fed a bit more leeway to drop interest rates a couple times this year. A couple months ago, they were already reducing the chances for any rate cuts, pushing them back to mid-year and maybe only one this year. And now all of a sudden that's flipped in a lot of economists' perspectives. But whether they will do it right now, I really don't have a strong conviction on that. I think that bonds and notes, which trade inversely to interest rates, are fulfilling the pullback targets that I had, and I thought we would see a low in them right here in this March 12th, 13th time frame. So if they start to move back up, that is certainly indicating that traders are expecting lower rates, but it doesn't guarantee that it's going to happen right at the next meeting.
This week on X, @BullReturns posted a lithium chart with the caption, "A wonderful 10 baggers set up for lithium for the third time." What are you seeing ahead for lithium?
I don't have a strong conviction on lithium. I'm not sure what @BullReturns or whatever it was is. I'm not sure if that's just cheerleading or if there's some strong support for that. I keep hearing the cheerleaders in lithium for months and even years, and often looking at just the demand side of the equation, but the supply just keeps skyrocketing, and I think it's doubled in the last few years, and that just continues to occur. You've had lithium, which kind of had a bubble back in 2021, 2022, and like so many bubbles, it subsequently lost about 85% of its peak value. And usually when you have a bubble bursting like that, it takes quite some time for a bottoming phase to really trace out and start to build a new base for a new advance. So right now, all I've seen is bearish technicals and indications, but that could certainly change over a period of weeks and start to show signs, supporting signs or constructive signs. But right now, everything remains in a very solid downtrend on the futures markets, which is what I will look at just to get an overall perspective. The June futures would have to get up above 1050 before they would show any signs of bottoming for me. But that's kind of where it's at right now. And like I said, things like that can certainly change relatively quickly, although that wouldn't change the major trend, but you could give signals of some sort of intermediate bounce in a very short period of time. But right now, everything still remains in the downtrend that has prevailed for the last couple of years.
Where can listeners subscribe to Inside Track with two eyes?
They can go to our website at insidetracktrading.com, and as you said, it's the word inside with two eyes in the middle, so it is INSIIDE, tracktrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Martin Straith, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
My pleasure, Jim, as always.
Martin, last month when you were on, you said that investors need to get politics out of their portfolio. Well, how is that possible with all of Trump's tariff talk?
Yeah, well, certainly Mr. Trump is making the headlines. I mean, my God, almost hourly on some days. It kind of reminds me of a kid playing with a light switch, flicking it on and off, just marveling at the reaction. But I think the issue is, to me, trying to predict these actions on any given day is really pointless. There's no doubt, that his actions are having effects on the market, at least in the short term. Tariff threats are newsworthy, but there's going to be a point, I think, for sure, where Trump's going to make a tariff announcement and the market's going to just shrug it off. His interventions are going to have less and less effect as markets start getting used to his voice and his routine. When he was elected, the markets really took off. Expectations of lower taxes, fewer regulations, cut the government fat, etc. The markets loved all that stuff. But now, we've got all these on-again, off-again tariff and trade wars. Companies don't know what the rules are. They don't know what the rules going to be tomorrow. They don't know what it's going to be next week or next month or even next year. And that creates a lot of uncertainty for those companies. And markets hate uncertainty. So, rather than listening to all the rants and stuff, we just watch the charts. We just try to take all the noise out of it and just look at what's the market actually doing. So we've got targets. And then what we do is we watch, to see when the bottom is in for this current side. I know it's hard to keep emotions out of your investing, but you need to try. I mean, we all have opinions, but what we do is we wait for the charts to either confirm our bias or opinion or to tell us that we're wrong, and then we move on to make our change. So one thing you're going to learn, after 50 years of investing is the market is never wrong. So knowing that, we let the charts and our models tell us what the market's doing and what we should be doing about that.
A few weeks ago, you added a hedge for your subscribers. What told you the markets were heading lower?
Well, just sort of like I've been saying here, we watched the chart. So I think it was on your show last month. I mentioned that, the S&P 500 was in a 2-year uptrend channel. So that's a very bullish pattern. And we told our subscribers, as long as it stays in that uptrend channel, stay long the market. It's in a bull market. It's going up. Don't fight it. Just don't overthink it. And then, just a few weeks ago, guess what happens? The S&P 500 fell out of that uptrend channel. And so that, to us, that's a trend change. Something's changed here. So we changed our position. So when the S&P 500 fell out of the uptrend channel, we added a hedge position to protect our subscribers. I mean, I know it sounds simple, but that's how we do it. We just simply let the charts dictate how we trade.
You've said many times investors need to understand currencies as everything's connected. What do you see for the U.S. and Canadian dollars?
Well, yeah, as I say, currencies, it's all connected. So if the U.S. dollar is rising, most other currencies are falling. From early October to early January, we had the U.S. dollar on a 2.5-year high. I mean, it was up 10% in just a few months there. And, and that's a crazy move for any currency, and a real crazy one for the world reserve currency. And then, so why was the U.S. so strong back then? Well, you had the U.S. bond market paying much higher yields than most every other country. So, you think about it. If you're a foreign investor, so, let's say you're a German or a Swiss investor. Well, Germany bond was paying 2.4%. The Swiss bond was paying 0.43%. So, what do you want? You want 0.43% or do you want 4.5%? So you have these investors, so they would trade in their Swiss francs or the euros. They have to buy U.S. dollars in order to buy those U.S. bonds. And then, so that just simply creates a demand for the U.S. dollar. And we had the same story for U.S. stocks. U.S. stocks far outperform European and Asian stocks. So again, if you're a foreign investor and you wanted to get in on the U.S. market that was performing better, well, then you would need to, convert those euros or yens into U.S. dollars to buy those U.S. stocks. And again, that creates more demand for the U.S. dollar. But now the U.S. stocks, things have totally changed in the last month. So now European stocks, especially German stocks, have significantly outperformed the U.S. stocks. And so now what do we got? We've got the U.S. dollar is actually turning down. So since mid-January, we've got the U.S. dollar falling. I think it's down about 6% so far this year. And, it's been falling along with the U.S. bond market yields and this U.S. stocks. Now, that trade, by the way, is getting a little bit overdone here. So we're looking to see that the U.S. dollar is probably going to rally a bit now. And then if we look at the Canadian dollar, I mean, I think every Canadian is well aware that, it dropped down to about 68.35 like a month or so ago. I mean, that was a 23-year low. And, of course, for families, I mean, that's brutal news. Your costs for imports, like food, those are going up. Traveling, especially to the U.S., I mean, you're paying about almost $1.50 for every dollar down there. But if you're a Canadian company, I mean, a Canadian resource company, if you got assets in Canada, I mean, that's a great combination. So, your costs are in Canadian dollar, but your revenues in the U.S. dollar. You think of a company like Agnico Eagle, there's a gold company. Well, their mines in Canada, so all their costs are in Canadian, and yet, we just saw gold hit $3,000 a day, and they're getting $3,000 U.S. for the gold. So again, that's a great combination. Looking ahead with this trade war with the U.S., unfortunately, it's going to be really rough on the Canadian dollar. Today, we're trading about 69.24 here. Now, prior to the tariffs, Canada was already in a horrible economic situation. We've had almost a decade of terrible government policies. We should be one of the richest countries in the world thanks to our natural resources. And, for the last decade or so, they've been basically left in the ground. So that needs to change. So today, we've got Mark Carney as the new prime minister. So we're going to have an election very soon. And hopefully, whoever is elected, whether it's liberals or conservatives, they give us a lot more than lip service to focusing on the economy. Canada needs to get its economic act in order here, or we're going to be way behind the U.S.
Do you feel the market correction is over to the downside?
Well, right now, the markets are in a steep downtrend correction, although it's having a big bounce today. So it's oversold in the short term. So like I say, here we are on Friday. It's up, I think it just closed about 117 points higher for the S&P. But we also had a big bounce on Tuesday, but it gave it all back on Wednesday. So, obviously things are pretty rocky right here. Now, at this point, to me, the market needs to prove when a bottom is in. And to me, that means we need to see the S&P 500 rally and hold above its previous support of 5670. So it's about, 5612 here, I think, right now. Now, if you're a day trader or a swing trader, you can take a run at some of these stocks that have been, absolutely hammered. I mean, Tesla dropped, over 50%. So, you can do swing trades on stocks like those. I mean, it rebounded about 15% in a day and a half. So you can make some really quick gains, but, those are very short-term kind of trades. And if your listeners are into swing trading at all, they should take a look at our technical trader service, which does swing trading as well as longer-term trading. Doing swing trades in this kind of market, it can be quite profitable. But again, just understand it's very speculative. Now, most of our subscribers are investors. They're looking for longer-term trades. So our trend letter service, we follow the trends. And then, as I said earlier, we let the trends and the charts dictate what our moves are. So on Thursday, the S&P 500 officially fell into a correction phase, meaning it was down 10% over the last few weeks. Now, that's the first 10% decline since 2023, when we saw it, drop about 11% from August to October 23. So since then, though, it's been in that uptrend channel that I mentioned earlier, and now it's fallen out of that channel. So this market, it needed a correction. It was very overbought. Now, the interesting thing to me is the problem for younger investors is that they've never seen real capitulation in the markets. If you look at a long-term chart of the S&P 500 since 2009, it's been in an uptrend. So, for those 16 years, it's all, it's every correction just, quickly recovers. And you think about it, it's amazing. Any financial advisor who's under 35 years old has never experienced a real stock market sell-off other than the COVID, really quick correction. A 30-year-old today, I mean, in 2009, they would have been, 14? So, so when we had the financial crisis, so they had no idea. So again, they don't know what a big correction looks like when it plays out. So again, we watch the charts and we're going to look for a trend change. Right now, the short-term trend is down. And as I said, the market's oversold here. We're going to see bounces. We saw one on Tuesday. We're seeing one today. But typically, if it's a severe correction that we're into, what typically happens after a big decline, we typically get false rallies. And these false rallies, what they do is they suck in the dip buyers, and then they typically get another decline, one that scares everybody. And that's, so second declines are the ones that force everybody to sell. And, it's, those declines after false rally, that's when, the investors get freaked out. That's when they swear they'll never trust the markets again. But again, remember, people under 35, they've never really experienced that. So I expect we're going to see a near-term bottom here soon. I mean, today may have been it, and we're rallying up. But then again, a rally that if it cannot push back above 5670, then we're very likely to see a deeper correction. So, your listeners need to, just be really cautious here. Now, one thing we are seeing again is sentiments getting very extreme on the negative side. We saw volume skyrocket this week, especially in the NASDAQ ETF, the QQQ. So again, that suggests we're very close to at least a temporary bottom. Next support level for the S&P would be about 5,400. So like I say, we're at about 56.15 right now. So that'd be about a $200 or 200-point drop from there. And again, though, I mean, using swing trade strategies to play some of these bounces can be very effective. But if you are going to be that, make sure that you have exit strategies in case that, we get that second wave down. Again, I know it's tough to keep emotions out of your investing, but man, it's so important to do. And again, that's why we just look at the charts and then let them dictate how we're going to trade.
When you were last on, you talked about how you were looking for a rotation out of big tech and into commodities like copper. We've certainly seen tech stocks get crushed recently. So what's the story with copper?
Yeah, we certainly have seen the big tech get crushed for sure. I mean, NVIDIA dropped about 30%. As I mentioned earlier, Tesla was down over 50%. So, we're seeing capital starting to, some of those people taking some of those big profits, and they've got the cash on hand, and they want to diversify. So they're starting to look at, things like copper and other commodities. And one of the things you have to remember, like it's so important to understand with commodities, is that you need to remember and understand the supply-demand price cycle. And for those who don't really know what I'm talking about, is, when prices rise, companies that are producing that product or that, whether it's copper or, uranium, whatever it is, well, when the prices rise, that increases those companies' cash flow and every other company that's in that sector. So those companies go, well, we're making good money here, prices are up, let's produce more of it. So they reinvest, increase production. But again, every company does it. And so eventually what happens is now supply starts to outpace demand. The prices then start to decline. That then decreases the cash flow. And now companies are at the opposite end going, whoa, we better slow down here. We don't want to be pumping out more and more of this stuff as the prices keep going down. So that forces cuts and shutdowns. And then eventually demand outpaces supply. And again, the cycle just starts over again. So just people should always remember that. So now we're looking at copper here. Now copper's up about 20% so far this year. Copper demand continues to grow, always grows. And that's even without the EV, renewables, and data centers. Yet the supply of copper has not increased. So if we get, EVs, renewables, and data centers, if, that keeps moving along, well, that's just going to add to the demand. Copper demand is expected to grow 70% by 2050. Economic growth, especially in these emerging countries, is going to be the big driver of copper. There's 1 billion people in the world that do not have electricity. So, that demand is going to continue to grow. Now, of course, we've got to be aware of tariffs. That's going to delay the commodity rally, so we need to be patient here. Now, a weaker U.S. dollar longer term will benefit commodities. And now, copper's up about 20% this year. A big part of that, I think, is that we've had companies trying to front run these tariffs. So they've been bringing in a lot extra copper, and so that's bumped the price up. But I think once we get these tariff wars to calm down, we're going to see copper and other commodities do very well.
Over 6 months ago, you called for gold to hit $3,000 in 2025. It tickled $3,000. It closed Thursday at an all-time high of $29.91. What's been the main driver pushing gold higher? Yeah,
gold's been on a real tear here, and it did. I mentioned earlier, yes, it hit $3,000 at one point. Today, I think it's still above 3,000. Since 2022, so October 2022, gold is now up about 84%. So compare that to the S&P 500, where it hit its high on February 7th, and it was up that same time period about 72%. Well, now it's pulled back, so now it's up about 80 or 55%. So gold then now is up almost 30% more than the S&P 500 over those couple of years. Now gold's up about 10% so far this year, so in about 10 weeks. So our call for gold 3,000 in early 2025 was pretty much right on target. What's been driving this impressive move? Well, we certainly had safe haven inflows. From some of the retail investors. Obviously they're concerned about, tariffs and trade wars, worried about economic impact. Certainly here in Canada, people are worried about their jobs, about the economy. I mean, it's unsettling and people are pretty nervous. And then, also American, European, other countries, they're also feeling uneasy with all this uncertainty right now. But even the recent scare of, trade wars, the average retail investor is not heavily invested in gold, if at all. And then let's not forget, the massive amounts of government debt globally. The U.S. is paying over $1 trillion every year now just to service the debt. That's more than they pay for defense. So it's crazy. So we've got governments, they're having to print money to service their debt, and that's killing the purchasing power of the local currency. So that just makes gold more attractive as a safe haven play compared to, say, government bonds, for example. Now, the real driver, though, for gold over the last few years has been central banks. After Russia invaded Ukraine, we had the West seizing all these Russian assets. Well, that really spooked a lot of countries, particularly ones that are not particular friends of the U.S. or the West. So we're talking, obviously China, Russia, Iran, etc. So these countries, they just started loading up on gold as a safe haven. Now, according to the World Gold Council, the top 3 reasons central banks have been buying gold: fear of inflation was number 1, gold's performance in times of crisis was number 2, and then the third one was portfolio diversifier, and that meaning basically protection from having your assets frozen. So now, while China did pause their purchases late last year when gold hit its recent high, these central banks generally do not worry about price. They're not price conscious when they buy gold. They just regularly buy it. And again, according to the World Gold Council, in the last 3 years, central banks have purchased over 1,000 metric tons of gold each year. And in the last quarter of 2024, they bought 350 metric tons in that quarter. And that was an increase of about 40% over the previous year. So today, with all the trade conflicts intensifying globally, that just gives, these central banks even more reason to load up on gold. So now we're seeing, retail and institutional investors getting into gold. A few weeks ago, I'm sure you'll remember we had statements that the U.S. government is looking to audit gold in, the reserves, like in Fort Knox. So that sparked some concern, certainly the conspiracy theorists, that, if gold wasn't accounted for, well, then that would really cast some serious doubts on how, trustworthy is the financial system. Think about it. If gold isn't there, if all that gold isn't where it's supposed to be, that would greatly increase the demand for investors to buy more physical gold. So for all of those reasons, we saw gold to hit 3,000, which, like I said, it did today. Likely probably hit 3,200 to 3,400 by the end of the year. The move in the last week, though, it's been a bit parabolic here. So we're looking for a correction or a consolidation phase, right around this level. I think that'd be very healthy for gold longer term. Parabolic moves are a bit scary because once they go straight up, they tend to see they run out of steam, and then they're just going to come straight down. So a nice consolidation phase would be really good for gold right about here. And, you got to remember, 3,000 is a pretty big psychological threshold for gold. So I think we're likely going to see some strong resistance around here, and certainly there's going to be some profit taken around this level. Our models are calling for this current run to maybe hit about $3,040, but I think that would probably be it for the short term. Now, if we see a ceasefire and ultimately, hopefully, peace in Ukraine, well, that's going to knock gold's safe haven war premium down. So, we're watching this 3,000 level to see if it does form strong resistance. If it does, the next support level we're looking at would be about 28.75.
What do you see ahead for oil?
Well, yeah, I was on your show last month, and oil was about $72. And I remember saying that we expected it would probably drop back down to around that 66 support level. We were looking for, our model's calling for it to have one more test of that level. Now, that's where we are today. So right now it's trading about $67. So that's the 6th time since September that we've tested around that $66 support level. And so far, each of those tests have held. So we'll see if it holds on this round. Now, you've got economic concerns with tariffs, potentially, the worry now is a potential global recession. So people then worry about lower demand for oil. And then we have a potential, like I say, that ceasefire, hopefully in Ukraine. And if that, if that leads to an actual peace settlement, that would add, more supply and more movement of oil, and that would remove the war premium on oil. So, and then of course we have, drill baby drill. And again, as we just talked about, though, remember that supply demand price cycle Producers are not going to keep pumping oil out if the price keeps dropping. So I think that will, supply demand will kind of take care of itself. And then longer term, you look at the demand side, I think I mentioned earlier, especially in emerging countries. Again, there's 1 billion people without electricity. And I think a lot of people keep forgetting that oil is such a huge component of so many other things we need and use every day. Clothing, smartphones, computers, shoes, medical supplies, tires for our vehicles, whether it's an EV or a gas vehicle, it needs tires. Asphalt for roads for those vehicles to drive on. I mean, you think about these emerging countries, they're starting to build more roads. They're just getting into this kind of level of stuff. These are things that we continue to use and need, and these are things that people in emerging countries need and they certainly want. So I don't see demand for oil going anywhere. I think we're going to hit $100 for sure, and over the next few years, I think we're going to hit at $150.
When you were on last month, you said Bitcoin fell out of its near-term uptrend channel in December and tested support at around $92,000. What do you see now for Bitcoin?
Yeah, well, I mean, as you say, the key for us is that Bitcoin fell out of that uptrend channel in December. That was a trend change. So since then, it's tested support at 92.5. It's tested that 3 different times. And then in February, late February, that 92.5 support level, it tested it again, and this time it failed to hold. So on that run then, Bitcoin fell all the way down to 75.4. Now today it's up to about 84,000. Now, Bitcoin's very volatile, but it often serves as a pretty good indicator on the broader market sentiment. So, when you get a rally in Bitcoin, that kind of tells us we've got a risk-on sentiment, for speculative sectors. And then when you get a decline, that tells us that we've got a risk-off mentality. So our models are indicating that Bitcoin, it could rally back up to that previous support at 92.5. But to me, that's going to act as pretty strong resistance. If that resistance holds, Bitcoin could fall all the way back. Our models are targeting a support about 73,000. Now, if it gets to that and it holds, I mean, that could be a good buying opportunity. And again, we watch the charts. We let the market tell us what it wants to do.
Can you tell us about your new decentralized finance service?
Yeah, I think we touched on it a bit last month. But for people that aren't that familiar, DeFi, or as you say, decentralized finance. So what we're talking here is we're talking about leverage. It leverages the blockchain technology. So that technology that cryptocurrencies use and Bitcoin uses. But instead of cryptocurrencies, we're really talking about the technology to deliver financial services without the traditional intermediaries. So like banks. So they're built on decentralized networks. So it's not centralized like a bank. It's decentralized, spread out over many, many computers worldwide. So networks similar, like Ethereum is one of those networks. Now, to put that into some context, I mean, think of it as getting in on the ground floor of a financial revolution. Think of it as like those who invested in Bitcoin over a decade ago. This is the same kind of thing we're talking about. I mean, that's the opportunity that DeFi presents today. It's not just a buzzword. This is a paradigm shift in how we make or how we're going to make financial transactions. So it's an ecosystem, of peer-to-peer financial services built on blockchain technology. So it's open to anyone with an internet connection. No paperwork, no middleman. So we've got the world's largest investment banks, from the Far East to New York. So, we're talking about banks including, JP Morgan and BlackRock. Now they're predicting that we're going to see about between $15 and $30 trillion market for real-world assets in the next 10 years. So we're talking about, making a digital transaction of huge range of assets. So we're talking assets of, ranging from like corporate government debt, to real estate, to commercial real estate, fine arts, commodities, you name it. And, think of it as like, when we had streaming services like Netflix came online, how companies like Blockbuster, they went bankrupt. Or how about instead of gambling online, where you go with the companies that operate like black boxes, where the players have really no way of knowing, if this game is fair, and instead you play it on a, decentralized finance platform. On a DeFi platform, you would have peer-to-peer betting using smart contracts, so that removes the centralized control and it allows the players to bet against each other directly. So, to me, it's a natural progression. Society is already rapidly shifting online. It's been driven by technology and convenience. Everybody now, business meetings, banking, investing, it's all transitioned into the digital platforms. So moving these transactions onto DeFi platforms is the next logical step in the progression. So early adapters, I know a lot of your listeners may not be that, they didn't want to get into Bitcoin back in the day. Maybe they're not even in it today. But the people that do, the early adapters, this is a really unique opportunity to capitalize on this shift, just as we saw, with the rise of the internet and Bitcoin. Now, let's be clear here. There will be a learning curve. Just like Bitcoin, investors there, they had to learn and understand, digital wallets, private keys, blockchain mechanics. Well, DeFi investors are also going to need to master, they're going to have to understand those digital wallets and master keys. And they're going to have to understand how, smart contracts work. But that's why we're creating this DeFi Digest. It's going to be a new newsletter, and it's going to address all of these challenges. We're going to provide guidance to help subscribers work their way through the process. Again, the learning curve is going to exist. But if any of your listeners, or if there's someone who enjoys exploring new technology and they want to be part of the next game-changing revolution, you'll want to check out our DeFi Digest. So this is for any of your listeners, Jim. If anybody is interested to get in on our list, then they will be getting the first issue of DeFi Digest, and they just send us an email with the subject line DeFi Digest and send it to info@thetrendletter.com. So that's all one word, thetrendletter.com. And we're not going to be charging the service for the first month or so because we want to get feedback from all those interested. And then it's, we're probably going to include it as part of the Trend Technical Trader service. And if people just want to buy the DeFi Digest, it will be at a very nominal fee. All right. So, anybody interested, just send us an email at info@thetrendletter.com.
Now, for those feeling uneasy in today's markets and wanting to gain a deeper understanding of how these markets are churning and how you might take advantage of it, you've reopened your special offer, giving investors 33 to 57% off regular prices. How do they sign up for that?
Yeah, so they can either send us an email at info@thetrendletter.com, or we do have a page. It's thetrendletter.com/special offer. And I think I did send the link to whoever runs your website there, so you guys can put it on there as well.
Martin, thank you so much for chatting with us.
Oh, always a pleasure, Jim. Enjoy the week.
My guest has been Martin Straith, founder of the Trend News, online at thetrendletter.com. He was speaking to us from Coquitlam, BC. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBethMcLeodPartners.com. You can find him on X at HMacBE. Welcome back to This Week in Money.
It's always a highlight to be on the show.
Would reading the second edition of your book, When the Bubble Bursts, be a good idea right now?
Absolutely. The part, most of the book was written 8 years ago. But the stuff that's happening today is coming into focus with what the book was talking about. So in 2017, we had a crisis in the housing market, which got resolved. In 2020, of course, we had a crisis. And then in 2023, 24, there was another downtick in the housing market. But this one now, in 2025, appears to be the big one that I was predicting in the book. And whether it's, excessive government debt or a recession or a tariff trade war, all of the things that the book talks about are starting to happen now. So people would find that very interesting, I think.
President Trump wants the movement from Canada to the U.S. of migrants and drugs, especially fentanyl, to stop. That's why he put tariffs on Canada in the first place. Investigative journalist Sam Cooper was on the show in February. What's known as the Vancouver model involves money laundering through casinos then used to buy real estate. He estimates that 30% of the value of Vancouver real estate is from laundered money. The fentanyl flowing from Canada to the U.S. is significantly greater than the 1% narrative mentioned by outgoing Prime Minister Justin Trudeau. Douglas Todd wrote this week in the Vancouver Sun, the Canadian governments failed to stop money laundering because they want the cash, says law professor. Douglas Todd quotes law professor Sana Ahmad. Once it is in the system, dirty money behaves just like clean money. Todd writes, governments quietly rely on it to prop up the domestic economy. Could President Trump's focus on Canada be very bearish for the Vancouver housing market?
Wow, there's a lot of questions inside that. Well, certainly the Trump's actions on tariffs, and it's not just Canada, but it seems to be especially Canada so far, but China has been impacted now as of when we're speaking here today on Thursday. Europe has been attacked by tariffs. Everybody's being hit by these tariffs, and of course what it causes is tremendous uncertainty. For example, just to focus on Canada, because the question is about Canada, the uncertainty that's created by the tariffs is negating the positive impact of the USMCA trade agreement that was negotiated and signed by Trump in 2017. And it's a successor to the North American Free Trade Agreement. And what it did was allow people to set up in Canada and then sell into the U.S. market. So it's not supposed to be fentanyl or laundered money through the Vancouver real estate, but it was supposed to be real factories with real product that would go into the U.S. market. And now with all of this uncertainty, and even if Trump isn't there forever, he probably won't be there much longer than 3.5 more years. The impact of this attitude in the U.S. could carry over. So people that are looking at investing money to expand their factories would probably go directly to the U.S. rather than locating in Canada. So that's one uncertainty. The other uncertainty, of course, is how it affects the consumer. So the consumer in Canada is going to be paying these tariffs because of the cost, increasing the cost of everything we import, and they're going to have less money to spend on a new house, a new car, an upgraded house, a renovation. So it's going to filter through the whole economy. So in my opinion, we were already in a recession before this happened, and now for sure we'll be in a recession, a pretty serious recession, and that would be very bearish for the Vancouver housing market. The housing in Vancouver and Toronto are so expensive that any kind of a crack in the speculative mentality that sort of has been heavy on the air whenever people talk about real estate in Canada, without that, these prices could come down by 50% or more. The normal ratio of income to house costs is sort of like maybe at the most 6 or 7 to 1, and Vancouver is up to around 20 to 1, and Toronto is up around 11 or 12 to 1. So they have to come down quite a bit to get back into the reasonable range where people could buy just with a salary. Never mind, dirty money being coming in from overseas, but just with a salary to buy a house on borrowed money through a mortgage, they would need a much lower price. So it is bearish. But on the other hand, when people say it's bearish for the housing market, it's really good for the housing market too. If house prices came down and people could get involved, because you need the first-time buyer to come in.
Should Canada be concerned about the 100% tariffs from China on canola, pork, and peas? I believe it's in retaliation for Canada putting a 100% tariff on Chinese electric vehicles.
That's correct. That's exactly what happened. So just to go back one step briefly, the U.S. put under Biden, this wasn't Trump, this was under Biden, the U.S. put a 100% tariff on electric cars from China because they discovered that, probably from talking to the U.S. manufacturers, that the Chinese cars were cheaper and better than anything they have to offer, other than maybe Tesla. So in order, under the free trade agreement, Canada was obligated to match that 100% tariff that Biden put on, and now China's retaliating. But this is very serious for Saskatchewan, Alberta, and Manitoba. Canola, pork, and peas. Those are, China is the biggest market by far for those for most of those commodities. So there's going to be real trouble. Now, this happened to the U.S. agricultural sector in 2017 when Trump was in the first time, and he had to, for corn especially, of course, a lot of it was going to China, and he had to do a major bailout, the billions and billions of dollars bailout to the farmers to keep them whole. One of the things that happens is you just get a huge surplus. We're going to be sitting on a huge surplus of canola and pork if we can't move it to China. And where's it going to go? The price would have to come down. Even if the price comes down, it may not be possible to move it. So this is a big concern. But we could probably negotiate with China a bit, more easily than we can negotiate with Trump. And if it means taking off that tariff on electric cars, I'd be in favor of doing that, because there's a lot of really good cars in China now that are electric, and then people wouldn't have to buy a Tesla if they wanted to go electric.
Are major real estate companies collaborating to fund foreign real estate investors through CMHC?
Well, there was a story in the, I think it was in the Globe and Mail shortly, like a week ago or something, that Bob Rennie had approached Mark Carney, who was candidate Mark Carney, who is now going to be Prime Minister as of tomorrow, to try and get something going for foreign investors through the Vancouver real estate market using cheap money backstop through the CMHC. It didn't make any sense. You read the story, you think, wow, he's approached him. What does that mean? He sent him an email. He never got a reply to the email. I don't know. But at any rate, it doesn't make any sense to use the CMHC to help foreign investors. Basically, what that would be translated to what's really going on there is there's a bunch of developers, and that Bob Rennie's one of the biggest condo developers in Vancouver, probably in Canada. They're sitting on a lot of inventory that they can't get rid of, and they know that they can't sell it it's way too expensive to sell to the local people, so they're trying to find a way to get more foreign money in. But I suspect, because of what we talked about a minute ago, that foreign investors are souring very quickly on Canada because of this skirmish, if not a war, that's broken out between the U.S. and Canada. So it's going to be very tough for those developers, and it's not going to. I think Mark Carney's got way more. He's going to have way more important things on his agenda to get through before he gets to worrying about condo developers in Vancouver, British Columbia.
This week, the Bank of Canada lowered the bank rate by 0.25% to 2.75%. The bank mentioned tariffs are a concern and that they're inflationary. Do you think this will cause the banks to be more liberal or conservative when it comes to issuing mortgages?
Well, the banks, of course, they're regulated, and they have to meet a bunch of restrictions on how they handle, especially when it comes to residential real estate. CMHC rules are a big deal. But they're also worried about defaults, right? So, and traditionally in the mortgages, there haven't been any defaults. It's like 0.01% default rate. But they must be getting worried now, because they are. There was one story a month ago in the paper about Toronto condos that are just being completed, and people signed up to buy them like 2 or 3 years ago with a tiny down payment, and now they're being forced to make the full commitment. And RBC was mentioned as a bank that was providing financing to these things at the original price that was contracted at the beginning. Now, I don't know if I believe that. That was the salesman for the condo developer, and RBC didn't make any comment on that. but they have to be concerned. I mean, if they're lending money, the reason that people can't close on those condos is that when the bank does a current assessment of what the condo's worth, it's only about 70-80% of what the contracted price was. So the buyer would have to come up with an extra 20-25% of equity in order to be able to get the same mortgage that they were promised, and that's going to be impossible. So it isn't so much that the banks are becoming conservative; it's that they are faced with an impossibility, because under the law they're not allowed to lend a loan bigger than the value of the property. And so even if they didn't care about the possible risk of losing money, which we know they do care, they by law aren't allowed to lend more than the appraisal value of the real estate. Now, you can always find friendly appraisers, but the other thing about this, they mentioned the interest rate came down. So the bank rate was 5.25% not that long ago. It was in 2024, I think in May of 2024. Now it's down to 2.75%. But that doesn't necessarily mean the mortgage rate has come down that much. So the bank rate can be manipulated by the Bank of Canada, but they can't manipulate the mortgage rate. So people that had a payment of 2% mortgage or 1.5% mortgage, and now they're going to have to renew at 4.5%, are looking at $1,000 to $1,500 per month more on that mortgage, and that's got to be a concern for the bank. So I think automatically they're going to become more conservative, even though they have these targets that they're given. They've got quotas they have to meet. They got to put out so many mortgages, so many credit cards, and all that kind of stuff. At some point, especially if defaults started to happen because of higher unemployment, they would get more cautious. And it happens every cycle. It's just so amazing. In this cycle, it's been 15 years since we've had a real significant, or actually in Canada, I was thinking about the U.S., it's 15 years. In Canada, it's basically 25 years since we've had a real significant downturn. And so the bankers that used to be concerned about losses and conservative lending and all that, they've all retired. And so the younger ones that were hired since then are more concerned about growing the size of the bank and getting more loans and getting more customers and all that kind of stuff. But it'll switch if we get into anything much deeper in a downturn than what we've got now. They'll start to turn more conservative for sure.
Canada is looking to retaliate with tariffs of its own. The Canadian tariffs are inflationary and will hurt Canadians by making them pay more, though the Canadian government will take in more revenue. Do you think retaliatory tariffs are a good or bad idea?
Well, I don't think they're a particularly good idea. They're not a bad idea. They're just something that has to happen. And every single situation where people have put tariffs on, which basically breaking the free trade agreement that we had with the U.S., Canada has no choice but to put tariffs on. There's no alternative. And the problem is they don't really work. They do, as you said, they do make things more expensive for Canadians, but also they don't really have much impact on Americans. So if the Americans did a tariff that's going to cost $1 billion, Canada's matching it on American goods of $1 billion sold in Canada. But because the ratio is more like 9 or 10 to 1, for it to really have an impact, Canada would have to do 10 times or 9 times as much a dollar value of tariffs as the U.S. is doing, and we're just not going to do that. So we're not going to hurt them nearly as much as they're going to hurt us. So I don't think retaliatory tariffs, whether they're a good or bad idea, they're not going to work. We have to do something else to get Canada's attention. Like people saw this week that the Premier of Ontario, Ford, said he's going to switch off the electricity to Michigan and to several other states. That got Trump's attention right away. So, of course, in Alberta, what we could do is switch off oil, and that would get his attention really quickly. And British Columbia could also switch off exports of hydroelectric electricity and maybe even water, although water's more difficult to turn off. If you try and turn it off, you fill up the bathtub pretty quickly, then it overflows. So, but anyway, there's things we could do. But tariffs aren't going to be it. It's got to be something a little bit more drastic than that. I wrote a weekend note, and I wrote it on January 24th. I think it was Canada should use the nuclear option. Well, the nuclear option is to cut off the oil Canada sends 4.3 million barrels a day to the U.S. from Alberta primarily, and the U.S. consumes 20 million barrels a day. So that's more than 20% of all the oil consumed in the U.S. comes from Canada. And if we shut that off, they would really feel that. The price of diesel and gasoline would go through the roof in certain parts of the country. It's not the whole country, but in the Midwest, Colorado, places like that, they're 100% relying on Canadian oil exported mostly from Alberta. So that would get their attention, but that would also create some real crisis. That would throw other things into a crisis. But that's the only way you're going to get Trump's attention.
Should the Bank of Canada raise interest rates to support the Canadian dollar?
Well, if only they could. It's like this slump in the real estate. So, of course, the thing about interest rates is that they work through the real estate market. That's primarily residential real estate is a primary way to stimulate the economy. So if you raise interest rates, especially when I've written a lot about and talked to you a lot about the Canada being one in the top three of all indebted private sector households in the world. If you raise interest rates, it just puts the Canadian household in deeper and deeper trouble, especially if there's a recession and people start getting unemployed. So that would help keep the dollar up, which would help us buy the more expensive goods that are coming in after they get a tariff on. But I don't think Bank of Canada has that choice, because it would make what's likely to be a deep recession an even more severe recession, and so I don't think they'll do it. They're going to try not to have the dollar go down to 60 cents, but if it has to go down to 60 cents, I think they'd rather do that than raise interest rates.
Are insolvencies rising, and are insolvencies a red flag for the economy?
So insolvencies are rising a little bit. They're still relatively low. The early warning, the canary in the coal mine, is I looked it up. Is the people that are only making the minimum payment on their credit card. So normally, people are just using credit cards to get the points, right? We all have a credit card. We get the points of airplane points or whatever, cash back, and pay off every month. But it's up to now something close to 11% of all people with credit cards are only making the minimum payment, and that's not because they've chosen to do that. It's because they don't have any choice. They just don't have the money. So an increase in that, which has gone up quite a bit recently. It's still well below the levels that were in 2008, 2009, but it's the highest it's been since then. So it's the highest in 15 years. In both Canada and the U.S., is an early warning indicator that people are in trouble. The other one is delinquency. So people who are 30 days or longer delinquent so they can't even make the minimum payment on their credit cards. It's gone from the very low level of 1.5% to 3%. And it's a doubling. But 3% is still pretty low. But it's the highest in the last 15 years since the 2008, 2009 global financial crisis. So there's for sure the early warning signs are there, but it takes a little while longer for a big jump in insolvencies. One of the things that Doug Hoyes is a fellow I know. He's got an insolvency operation in Ontario. I think the biggest one in Ontario. He and his partner, and they have noticed that people are coming in to apply to go through the insolvency, whether it's consumer proposal or bankruptcy. And one of the things they keep track of is they put out a report. It's quite interesting reading. Is the income. So a few years ago, the average income was around $2,200 a month. Now it's up to $3,500 a month. So people with houses they never used to see people with houses. Now they're starting to see people with houses. The average income of the people has gone up by almost 50% of the people that come in and ask for an appointment to find out what they're going to do. So it's starting to impact the more affluent members of society, and that is a red flag right there. But the insolvencies are a lagging indicator. The leading indicator would be the credit card delinquencies. That's when it shows up much more quickly, because people will do anything to hang on to their home, but if they have to default on a credit card, then that's not so serious.
In early February, Maxime Bernier, the leader of the People's Party of Canada, was on the show. His platform includes removing the capital gains tax and giving businesses a flat 10% tax, lower personal taxes, abolish all corporate subsidies, get rid of excessive regulation, remove impediments to exploitation and export of natural resources, drastically cut government spending, and mandate the Bank of Canada to stop printing money. Do you think these ideas are good or bad for stimulating the Canadian economy?
Well, a lot of that looks like it came right out of the U.S. in Elon Musk's Doge or the Trump tax plan. And of course, the problem with that stuff, it probably would stimulate the economy, but the problem is, especially on the tax side, the deficit would get much bigger. So the story has always been you cut taxes on the rich, and then the money trickles down to the poor people, and it stimulates the economy, and it actually it ends up generating more tax revenue. Going all the way back to Ronald Reagan in I think even in the 70s, they had people saying this. I actually the first time I found reference to it was in the 1920s. Under the president then, and they were talking about trickle-down economics, and it just doesn't work. So you've got a certain amount of things you have to do in society, and you have to have tax revenue to pay for those things. And the sad reality is you don't really collect much income tax from the poor people or even the middle people. Most of the income tax, especially in Canada, is paid for by the high-income people and the people with corporations. And the people that have capital gains on their investments. So if you give them a break, then what are you going to do? You're going to either run a bigger deficit, or you're going to cut out essential services, or you're going to cut out the waste and the fraud in the government, if there's enough there to make up for it, or you're going to run a bigger deficit. So it's it'll be interesting to see what Elon Musk is able to do in the U.S. He's not looking very good so far. He's claimed a bunch of savings, and he's found a bunch of fraud, and he's got a website that's listing this stuff. And people go on the website and they find out that it's overstated. It's basically sometimes completely fabricated, and it's not happening. So we'll know in a few more months whether that sort of thing works. In the meantime, the U.S. deficit is running even hotter than it was before, and there's been very little impact of. So we don't need to try these things in Canada. We can just wait 6 months or a year, and then we'll know whether they work or not, because we'll be able to watch the experiment that's going on in the United States.
Yes, I was going to ask you a question about that. I think you answered it. Now, gold hit $4,000 an ounce Canadian. Do you see gold? Where do you see gold going from here?
Yeah, so I usually follow it in U.S. dollars. So U.S. dollars, it's just today, just about $3,000 U.S., and it was $850 in 1980. And I remember that day, the day it hit $850, I was interviewed. The TV cameras came into our little brokerage office, and here I am in my stockbroker's desk with my phone and my quote screen, and they did an interview with me about where's gold going to go from here. Well, it turned out, coincidentally, it was the exact day of the peak at $850 an ounce. Went way down to $100 or $200. Now it's up to $3,000 45 years later or whatever it is. So when you take the inflation into account, you need to actually get to $3,276 an ounce U.S. to meet that high that was hit that day in 1980 of $850. So we're still we still got to go another 10% to get to that level. But I we've had some really bad days on the market the last week or two because of this tariff war and other things. And the gold and the gold mining shares have been doing well. And you and I have talked about the gold mining shares before. So I think it looks. Of course, I'm invested in them, so I'm going to have a positive view. But I think it looks very promising for gold and gold mining companies because there's very little interest. The people that normally would have gone into the gold mining shares went into Bitcoin instead, right? All those coins and stuff. So So the people that normally would have been speculating in gold haven't even arrived yet. So there's still all that upside when they actually discover gold. They're not here yet. So far, the gold price has been moving up. A lot of it's been institutional buying. A lot of central banks, China, different countries have been increasing their gold reserves. And of course, gold production, it's really hard to find a good gold mine and increase production. So it's not that you have to buy it from somebody else. And if the price is rising, maybe the people are reluctant to sell it. So I think it looks very, very bullish for the upside.
There's rumors the Mark Carney government will be against oil and gas, but open to more mines to supply green energy to combat climate change. Could this rumor make sense?
Well, Mark Carney gets sworn in tomorrow on Friday as the new prime minister, and the rumor out of Ottawa today is that he's fired that Gibault guy that was the minister of environment. So I think that's a signal that he's going to maybe move back towards being more in support of oil and gas and less focused on converting to renewable energy. Although his history has been very heavily involved in promoting renewable energy. He's been involved in several initiatives along that line. So the rumor kind of makes sense because of his background, but I would suspect for political reasons until, the election's probably going to be called next week or something like that. It'll be over in 30 to 60 days, I guess. What's that, May somewhere? Then he could go back being more favorable towards renewable energy. But for the next 60 days, it's probably going to be looking more like he favors continued production of oil and gas. Oil and gas could be around for a while longer. It's not going to be around forever, though, because as we talked about with the electric cars, the conversion to electric cars, and you haven't asked me about that yet. Usually ask me that, Jim, about electric cars. Somebody would like. Anyway, I'll just assume you were going to ask me about that. The two countries, Canada and the U.S., are the only countries in the world, and of course they're big countries, big car-owning countries, where the pace of growth of electric cars has not been pretty spectacular. And so all over the world, people are switching to electric, but they're not necessarily buying the Detroit GM, Ford, Chrysler electric cars. They don't have that many offerings. And Tesla now has a black mark on it because everybody's mad at Elon Musk. So the companies like BYD out of China are just going crazy with sales all over the world, other than in North America. But it's inevitable that they will take over. And the thing is, there's 9 million barrels a day. 45% of all the 20 million barrels that are consumed in the U.S. are going into cars and light trucks for gasoline and diesel. So it's going to have a huge impact on the oil and gas market. And but that's a few years down the road, but it's not forever. It's 10, 20, 30 years down the road, but it's not 100 years down the road. So yeah, I think the trend towards electric vehicles, you reach these things called a tipping point, and eventually it just switches over. And even Elon Musk's incredibly bad behavior isn't going to stop people from buying electric cars.
How important is it to remove provincial trade barriers in Canada?
Well, briefly, I've got a story about that. So before I became a stockbroker in 1978, I briefly worked for the Alberta government, and I was in the department that dealt with other provinces, Intergovernmental Affairs it was called. And we had a task force to figure out how to remove provincial trade barriers in Canada. And we didn't get very far because every province wants to protect its, like alcohol production or wines or whatever, or dairy. So they'll have another go around on it. And they'll do what they can, but it's not that important. It's really not. We aren't a big market for each other. The big market is out there outside of Canada, right? The U.S. being the biggest market, Europe, China. I mean, these are where all the people live. If you open up barriers to Newfoundland, what do you get? Like, how many hundreds of thousands of people do you get access to, right? So it doesn't really work. So it's not that important to answer the question.
Yeah, access to Bill and Bud and Bobby.
Yeah.
Maybe Laura.
What are you going to sell them? Those guys don't buy anything. What do they buy? They buy a truck and they buy some beers and I don't know. They
and
don't even
storm
buy that
chips. They always buy storm chips. It's big in Atlantic Canada. Whenever a storm's happening, you go to the liquor store and stock up on beer and potato chips.
Potato chips. Yeah, well, that doesn't sound too bad. Actually, we got a snowstorm hitting Edmonton where I am. It's 20 centimeters are coming, so I think hunkering down is not a bad idea.
Hilliard, thank you so much for being on This Week in Money. Where can people follow you?
So on X, formerly known as Twitter, I'm as you mentioned, HMACBE, and then I'm also on Blue Sky with the same handle. And we also have a weekend note that you can get through our website, MacBeth.McLeodPartners.com, or you can find it like on Friday when we post the weekly note on Twitter or X, I should say, and then follow the link there and then sign up for it there, or just contact me directly through Twitter and I'll sign you up.
Hilliard, thanks again.
Thank you.
My guest has been Hilliard MacBeth. You've heard all of his contact information, and that wraps up our show. We'd like to thank our guests, Ross Clark, Eric Hadik, Martin Straith, and Hilliard MacBeth. And if you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.